Welcome to the Explainer. Today we're going to break down exactly how you can skip all that confusing Wall Street jargon and, just build wealth simply. If you've ever felt totally overwhelmed by the constant noise of the stock market, trust me, you are in the right place. We're cutting right through the complexity to show you an evidence-based path to investing that definitely does not require a fancy finance degree.
Here's our quick blueprint for today. We've got 6 clear steps: the active management problem, enter the index fund, tracking the S&P 500, why passive beats active, the ETF evolution, and finally, your simple investment strategy. Let's get right into it.
Section 1. The active management problem. High fees, low returns. So for a really long time, the standard advice was basically to hand your hard-earned money over to highly paid professionals running actively managed mutual funds. The fundamental problem here? You're paying top dollar for these massive research staffs and so-called expert stock picking. But, well, the data reveals a pretty hard truth. This expensive service usually underperforms over time. You're essentially paying a massive premium for what amounts to guesswork, and it just quietly drains your wealth behind the scenes.
Now, back in 1974, a guy named John Bogle founded a major investment company, and just 2 years later, in 1976, he launched the first publicly available S&P 500 index fund, designed specifically for everyday ordinary investors like us. Wall Street literally laughed at his invention. They famously called it Bogle's folly, mostly because it completely bypassed their highly paid managers. But just look at the timeline today. Index funds now manage trillions of dollars. This incredible underdog idea spread like wildfire, conquered the financial world, and completely transformed how millions of people invest.
Moving right along to Section 2. Enter the index fund, a passive approach.
An index fund is a total game changer because it completely removes the guesswork. Instead of paying managers to, try to predict the future, an index fund just passively buys the list. It buys all the securities in its target index in the exact same proportions. This means there's absolutely no stock picking, no guessing, and crucially, zero expensive research staff to pay. It's basically investing put on logic-driven autopilot.
Now, to really understand the fund, you gotta understand the index, which is essentially just a master list acting as a blueprint for a specific part of the economy. A market index is simply a collection of securities representing a segment of the market. Actually, think of it this way. Instead of trying to find the needle in the haystack, the index is just buying the whole haystack.
All right, Section 3, tracking the S&P 500, the 500 largest companies.
You've definitely heard of this one on the news, right? The S&P 500. This is a market index tracking approximately 500 of the largest publicly traded companies in the United States, covering a huge range of industries. When you buy an S&P 500 index fund, you instantly own a tiny piece of the 500 largest companies in America. With just one single purchase, boom, you're getting massive instant diversification. You're basically betting on the long-term success of the American economy as a whole.
Which brings us to Section 4, why passive beats active. Lower costs, better odds.
Just look at that tiny number, 0.03%. That is the incredibly low expense ratio you can get with an index fund. Compare that tiny fraction to the 1%, or honestly even more, that you're typically charged with an active fund. That 0.03% means you're literally paying pennies on the dollar to invest. It might seem like just fractions of a penny right now, but that difference compounds so dramatically over the decades. Keeping your investment costs to absolute minimums, that's one of the most powerful, absolutely crucial secrets to long-term wealth.
You really got to notice the David versus Goliath reality we have here. On the active side, those managers are trying their absolute hardest to beat the market. And because of that effort, they charge really high fees. But research consistently shows the majority of them just completely fail to beat the market over periods of 10 or more years. On the flip side, the passive index fund doesn't even try to beat the market. It charges ultra-low fees because it simply is the market. You get the market's total return without the massive anchor of hefty fees dragging you down.
And hey, if you need proof that simple is better, look no further than arguably the greatest investor in history. Warren Buffett has repeatedly stated that for most ordinary investors, a low-cost S&P 500 index fund is simply the wisest choice. In his 2013 letter to Berkshire Hathaway shareholders, he actually noted that he instructed the trustee of his estate to invest the cash inheritance for his wife in a low-cost S&P 500 index fund. His reasoning hits the nail on the head. Consistent low costs and broad diversification absolutely outperform active strategies over time.
Okay, Section 5, the ETF evolution, modern index funds.
While traditional mutual funds are fantastic, they do have a specific limitation on when exactly you can buy and sell them. So the investment world asked a pretty brilliant question. What if you want the broad, safe diversification of an index fund, but you also want the modern ability to trade it exactly like a regular stock? Well, that leads us to a massive modern innovation.
Enter the exchange-traded fund, or the ETF. An ETF is functionally very similar to an index fund. It holds a collection of securities and usually passively tracks an index. But ETFs offer the exact same low-cost strategy with the awesome added flexibility to buy and sell at any second the market is open. They literally trade continuously on a stock exchange throughout the day. When you look at the underlying mechanics, they are nearly identical for long-term investors. Both give you very low costs and really broad diversification. The only real difference here is that the index mutual fund prices just once per day at the market close, making it a strict long-term hold, while the ETF trades continuously during market hours. For the vast majority of long-term investors, this trading difference is kind of irrelevant, but hey, it gives you some great options on exactly how you want to manage your portfolio.
Finally, Section 6, your simple investment strategy, consistency and patience.
So what does this all mean for us? Well, the most empowering takeaway here is that you absolutely do not need to be a sophisticated Wall Street insider to win at this. Low-cost index funds or ETFs are the perfect starting point. According to financial experts, building a simple, consistent portfolio of just one or two low-cost funds, like say a total U.S. stock market fund and a bond fund, is a profoundly sound, evidence-based, winning strategy. You don't need to pick stocks. Your real superpower here isn't predicting the future at all, it's simply having consistency and patience over time.
Look, Wall Street desperately wants you to think investing is terribly complicated, mostly so you keep paying them to figure it out for you. But with index funds and ETFs, you have the ultimate blueprint to build wealth simply and quietly. So I'm going to leave you with this question to think about. Are you ready to stop guessing on individual stocks, finally avoid those high Wall Street fees, and just let the growth of the entire market work for you? The tools are right in front of you. Thanks so much for joining me on this explainer.